It's a great pleasure to be here, and it's an honor to speak after Sarah's inspiring and uplifting presentation. I'm afraid I won't be able to be as uplifting as Sarah has been. So my topic will be climate finance, and I will give you my assessment of where we are today and some suggestions of what we could do to improve the state we're in today. So here's a I know some of you have to look up vertically. I'm looking down at the screen. So here's an outline just so you can track what I will be saying. Maybe I will give you too much in terms of detail, but I think this is the roadmap. And I thought I'd start with explaining why we're talking about climate finance. This is certainly for those of you who come with an economics background, that's not completely obvious. So here's if you want, a 4-bullet point summary of economics of climate change. So we know climate change is caused by the accumulation of greenhouse gases in the atmosphere. We know greenhouse gas emissions are not priced adequately and are therefore excessive. And the economic solution here is a global carbon tax to internalize the greenhouse gas emission externality. And the efficient level for the tax is a tax that's equal to the social cost of carbon. Okay, so that's a very brief summary of how economics frames the question. And what I want to point out, what I want to remark is that there's no special role for finance in this analysis. The other thing I think that's self-evident that all of you know, but is important to nevertheless remark is that the business and finance community has generally been hostile to carbon taxes. And I will try and suggest that one of the developments that climate finance offers is to break this uniform reaction of the business community, split the community into those who welcome more climate policies and those and not just have everyone oppose climate mitigation policies. Okay, so what makes finance relevant? So, you know, we teach our students principles of finance, and you know, in theory, it all looks very nice. What's important about financial markets is, well, they price risk, they discount free cash flows, they give you valuation of assets, and financial markets help fund positive net present value investments. Okay, that's in theory. In practice, it's more complicated. Here I'm giving you a quote by Robert Litterman, who until the financial crisis was the chief risk officer of Goldman Sachs. And here's what he said, is that what caused the financial crisis was a systemic risk that wasn't being priced. Not pricing systemic risk leads to too much risk being taken, and such a situation will eventually lead to a high probability of a global catastrophe. Okay? And what's another risk that's not being priced? Climate change risk. So that's the point he was making. Okay, so now a word about the rise of climate finance, and I thought I would start by giving you a bit of personal history because, as Mike emphasized, I'm an economist. I come from contract theory, from corporate finance, you know, industrial organization. How did I end up doing this? And so it all started in 2010 when I was co-organizer of a big conference at Columbia on sovereign wealth funds and long-term investing. So I came to this through the angle of understanding what is long-term investing, and in particular, what is long-term investing for sovereign wealth funds. And you know, it dawned on us, my co-organizers, Frederick Samama and Joseph Stiglitz, that climate change is a central issue for long-term investors, especially sovereign wealth funds. So that's how I got into it. And then, everything started from there, and I continued my collaboration with Frederick Samama, and just give you very quickly some of the things we did following the conference, to emphasize that we were really trying to be innovative in terms of practical solutions. So first practical solution, a paper with Frederick, and also some of you may know Mats Andersson, who was the CEO of AP4. So we basically developed a market index for passive investors that has a low carbon footprint, so-called low carbon leader indices. Later on, with Frederick and Joe Stiglitz, we worked on how you can change the business model of development banks to be able to scale up sustainable infrastructure investment. And so on and so forth. I don't want to belabor things too much. I mean, another thing we pushed was the importance of understanding climate change as a financial risk and potentially a risk that is could put put financial stability at risk, and therefore is a topic that's relevant for central banks. While we were doing all this, there's been a huge increase in climate finance. Just two pictures here. You can see on the left side, in terms of assets under management, how it went from close to zero in 2006 and reached something like 60%. If you're looking at assets under management of all the signatories of the Principles of Responsible Investment. And then you have a slightly smaller share if you look at the signatories or the members of the Climate Action 100. And then on the left-hand side, you can see how this increase in asset under management, you think of it as an increase in flows, translated into higher returns. So this is a paper by Pastor, Stambaugh, and Taylor. So they did a split. They classify financial assets into green and brown, and they point out that over this time period, you've seen basically a higher cumulative return for green investments, and that's you'd expect that if you see a flow of money going from brown towards green. While this was happening, there were many milestones. Let me just mention a few. Around the Paris Agreement, you had the speech by Mark Carney, Breaking the Tragedy of the Horizon. The first time a governor of a major central bank decided to speak about climate change. You had the founding of the TCFD. We heard a lot from Sarah about reporting. So that was the beginning. We had the founding of SBTI, Science-Based Target Initiative, which is helping corporations to decarbonize and make decarbonization commitments. And 2017, the launch of the NGFS, Network for Greening the Financial System. This is the network that includes all the central banks around the world that are working on trying to understand and supervise and maybe even regulate climate change risk. And you had the foundation also of Climate Action 100+. This all culminated at Glasgow with COP26, with the founding of the Glasgow Financial Alliance for Net Zero, which was founded, the head being Mark Carney. Okay, so that's all great, but as we've heard in the introduction, there have been also there's been pushback. I will call this setbacks and backlash. Okay, the limits. So ESG is losing its luster. Many people are increasingly skeptical, mostly over greenwashing concerns. So that's a problem. Second problem, when it was time to actually put actions behind words, a lot of big players just pulled out. The main one being Vanguard, which quit the Climate Alliance because suddenly it was asked to do stuff that it didn't want to do. Then you had significant outflows from ESG funds in the last year. You can see this as the chart here. And then the rise of anti-woke capitalism. Because of the energy crisis, we had monster profits for energy giants, and people quickly change their mind when they see money to be made. And here you have a photo. Sarah mentioned Larry Fink earlier, but this is Larry Fink doing a deal in I forget where, Abu Dhabi or the United Arab Emirates. So basically, the rise of climate finance has stalled, and really you wonder, is it too little too late? Global warming is accelerating while investors are dithering. And here's 3 charts just to remind ourselves how global warming is already affecting us in ways that weren't fully anticipated. So here you can see that for the last year, so starting in June 2023 until May 2024, we've had one entire year of average global temperatures above 1.5 degrees centigrade. Okay, 1.5 degrees centigrade was the limit not to cross set in Paris. Well, we've already crossed it. Here's another sobering chart. This is from NASA that monitors concentration of greenhouse gas parts per million in the atmosphere. And you can see over this time period, when I was showing you the rise of climate finance, lots of other actions were being taken. Well, has it made a difference? No difference. It's a straight line. It's a straight line. Okay? And what about carbon emissions from human activity, from energy-related consumption? Again, you could see that these emissions are now approaching 40 gigatons per year. There's no slowdown. There was a tiny little blip during COVID, but there's no slowdown. On top of that, I think what we're seeing increasingly is there's an insidious climate policy cycle. So we start gathering political coalitions, growing political coalitions by raising awareness, showing the evidence of devastation from climate events. That's all good. This then results in new policies. But then when the costs of those policies become visible, there's a backlash. And then you either have a U-turn or you try and placate the opposition through subsidies. Either way, this is very costly. And here is one example of what we're talking about in terms of size of subsidies. Okay, so this is as a percentage of GDP per capita, the subsidies in the European Union to cover the higher energy costs that we've had. And you could see most of them are between 4% of GDP per capita, 5.5%. That's massive. Okay, so we are facing a challenge, and so what is the challenge? What I want to turn to next, and what can we do to try and break into a better direction? So first point I want to make is that the challenge we're facing is not that there isn't a lot of goodwill out there. There is a lot of goodwill out there. There are many worthy initiatives. And all the examples that Sarah mentioned, they're fantastic. What's the problem? The problem is it's not enough scale. That's the problem, okay? And here, I just want to highlight, at COP28 last year, there were 100,000 people attending, 3,631 NGOs, COP28, okay? So, yeah, it's proliferating, but it's not coordinating. I think that's a big problem. And so what we need is better coordination, trying to reach scale. And before I get to what I want to say about scale, let me also briefly mention that we've also had a huge increase in number of countries making net zero commitments. Okay, so many net zero commitments, so similar to all these initiatives, but not enough detailed plans. So how do you put all this together? Here's what I'd like to put as a proposal. So to help coordinate dispersed initiatives, countries that have made net zero commitments need to provide detailed transition implementation plans. That's going to help with the coordination. If we know what are we going to do, what's step one, what's step two, what's step three. And what that means is, particular, is detailed, synchronized phase-in of green operating assets and phase-out of brown asset pipelines that must be specified in each sector. That basically doesn't exist. It doesn't exist. And unless we do this, country by country, 140 countries, sector by sector, there's going to be this big question mark over all these commitments and all these net zero targets. So let me conclude. We've reached the end of the road of the approach by default of relying on a brilliant diversity spread like stars, like 1,000 points of light in a broad and peaceful sky. I'm quoting from a famous speech by President George H.W. Bush at the Republican convention when he was declared the Republican candidate for election. Okay? Or more recently, to quote John Kerry on Climate Day in 2016, who said, the governments aren't going to do it, we're providing the invitation and the structure, but it's the private sector that's going to lead the way. That's just not credible anymore. It's no longer believable that the transition to a sustainable economy can be achieved on the fly. Governments urgently need to raise their game to have any hope that their climate policies will be taken seriously. Just being taken seriously. Whether they'll work or not, that's another question. But right now, it's a credibility question, where people are losing faith in all the discussions, all the climate policies that are being pitched in 140 countries around the world. With that, I will stop. Thank you.